All right, hello and welcome back to season 2 of the Technical Bootcamp. In this episode, episode 3, we are talking about supply and demand fails. So sometimes supply and demand zones won't hold, they will fail. But this is not always a bad thing because although it can sometimes lead to losing trades, it also opens a lot of opportunity. So in this class, we're going to look at what to do when these zones give way, how you can turn these fails into high clarity scenarios and open up new opportunity, and even how to spot these failures before they occur. So you can, number 1, avoid taking trades from bad zones, and number 2, potentially even trade against it sometimes. So this one's really useful, really interesting video to expand upon supply and demand. With that said, let's get straight into it. So first of all, just a quick rundown of supply and demand to refresh your memory if you've been watching the bootcamp, and if not, to align you with it so you understand this class. Supply and demand refers to areas or price zones in the market where we've seen significant institutional buying or selling taking place. They are seen essentially as discount or premium price levels to buy or sell from. So a supply zone, like this, is basically an area in price between a low and a high, so just a little price range, that the market has created a bearish impulse from previously. And what we can gain from seeing a strong bearish movement is that the area just before it, which in this case is this sideways candle, this indecision candle with up and down wicks, before the impulsive explosive movement, was basically the final point of which orders were distributed into the market before this large push down. Now, these large movements in markets are caused by institutions, so very large sums of money being transacted at the same levels. By seeing the fact we had a small sideways move before the impulse, it tells us that institutions are seeing this price range as a premium price to sell from. The theory then is, if the market returns back to that level, we will see new participants or the same participants who want to add orders selling here again because it is a premium price. It's proven to be of interest because it was previously. So if we see the market return to there, the idea is then that we should expect to see continued sells as new participants enter the market short, okay? So that is how a supply zone works. A demand zone is just the simple opposite. That is going to be a discount price. So I've just flipped the chart upside down, but this highlights it pretty perfectly. A sideways movement before a bullish impulsive move shows us that this area here, just before the impulse, was where significant buyer interest kicked into the market. If we return to that level again, traders will see this as a nice discount to buy this asset, so they will do so, and we will see an extension higher, okay? So that is how traditional supply and demand works. Generally, you just look to trade supply zone retests by going short, and you look to trade demand zone retests by going long. Nice and simple. Okay, so now we're familiar with what supply and demand is, let's take a look at supply and demand fails. So this is an example of a market that is trending to the upside. We've had a large impulse out of this demand zone that created an imbalance to the upside. Now, generally, understanding that this is seen as a discount price range, we would expect that when the market returns to this level, we could have opportunity to potentially buy. So the first movement we could look for from this trade as we tap into here is basically looking at the previous lower high and saying if the market's able to push over that lower high, we can look at pullback opportunities to buy to take this market higher, because then we would have our standard confirmation in line with this nice demand or discount price level, right? So that would be how we would look to operate this trade. Now, as we said though, not always will we actually follow through with the strong demand zones that we want to see. Sometimes supply zones and demand zones will indeed fail. So here we see that the market did not push over the high and instead is actually broken down through the level of demand. Now, as soon as we cross this point, where we get to here and we actually essentially print price beneath what is seen as a demand zone, the demand zone is no good anymore. Let's talk about why that is. When we take a look at a demand zone or a supply zone, we are looking at a discount or premium price level of significant buying or selling interest. So in the case of demand, what we actually see when we mark up this candle and the impulse is at this level, back here, massive amounts of institutional buying stepped into the market out of this little bit of consolidation. So drawing to accumulation and distribution, this is essentially where orders or positions were built, they accumulated, and then they were released. And that is where we get this massive drive of demand. This alone, the impulse and the consolidation before it, what we classify as our demand zone, tells us that basically this is a discount price level that traders are very happy to buy this market at, okay? So with that in mind, we know that this is a very primed buying point. Now, if we have buyers wanting to get into the market, but price is up here, it's up here, it's up here, they're not going to be too interested in getting up there because this is kind of a premium price to pay. And generally, if you buy, you want to buy at a discount, right? Now, the idea then is when we hit this level again, we should see a very quick and impulsive reaction, right? We should see this kind of skyrocket. We might get that very solid, easy break and then a small pullback and then a very nice, fast rally. Drawing in the momentum concept that we've discussed in previous bootcamp episodes, this movement is so fast and so strong, and then this movement is slow and choppy. We would generally be looking for another one of these fast, strong movements to reform out of this movement because we see sellers are not that strong, buyers are very strong. So when we reach that level that buyers were strong from, we should think, okay, traders were happy to buy here in mass before. This is a discount price. And now that the market has traded even higher, this becomes even more of an attractive discount price. So if we don't get an immediate, very strong reaction, and the market instead is able to come down and trade into the zone for a second time, or even through the zone as we've seen here, then that tells us that the demand zone that we're looking at is just really not that strong. Because obviously the buying interest that we saw back here is not coming back at this phase where we've tapped into the zone again, right? So we learn from that this demand simply does not have the interest that it previously had. And with that demand failing, that tells us we should no longer be looking at buy side opportunity, but we should probably be looking at selling opportunity. Now, we don't have to sell forever. We just have to sell down to where the next potential point for market reactions could be. So if we look to the left over here, we see there is an efficient range, right? We've created efficiency. This zone was retested here, and all of these zones have wicks retesting every single zone. Then we have a notable imbalance, and then we have a demand zone, which sits just here. So this demand zone becomes a core point of interest for a potential short position, because at this point, it's the next possible area that the market could realistically create a good reaction from. So we mark this as a very high probability target, and now that we've broken through this low, traded into an efficient range, and proven that buying interest is just not here anymore, the buying interest is likely to come in at minimum down here as the next point. So what we can actually do with this demand zone fail that we've seen is assume this is a discount price that maybe traders will be likely to buy at, but not up here anymore. They're not just seeing this as the discount or the great value offer that it once was. So we can now shift the narrative the other way and keep it super simple by just trading with the trend, right? So when we're in a downtrend, all we are looking to do is sell from supply zones, providing the market stays in a phase of lower lows and lower highs. Now, if we take a look at this market, then we have a lower high, and then these are also lower lows, lower low, okay? So we are still maintaining that downward trend. Now, as we can see from what we usually do, we want to trade supply zones in these movements. So we're looking to catch trades essentially at these peaks, right? So the next thing to do from this point is simply to identify where the open supply zone would be to sell from, because by failing the demand, we've created some bearish structure and we've basically opened the doors to confirmed downside at this point. So we can mark up the clear supply. Where's that going to be? Well, there is one imbalanced supply and it's this blue candle just here, the last candle before the impulse down. That's going to be our selling point. Our trade could look like this. We could sell there. We could have a stop over that zone and we could have our targets into this zone, because now that this demand has failed, it basically tells us the market's still got some downward movements to make and we are likely to trade towards the next imbalanced discount price level or demand zone. So this would be the position we would then operate to, which in our example is basically this. That's what we're looking for, okay? And that's it. So let's run the market forward. We get a tap in there and then we get a run down and a retest of that discount price level. Now, if you see what happened next, we tap into that zone and then consolidate a bit, but eventually start making some movements to the upside, which tells us that this area now is likely the more focused area for that new significant demand, okay? We have retest and then we have a rally away, which shows us traders are seeing this as more of a discount price or a fair deal than they were at this previous demand. And that's basically what we're drawing out of supply and demand fails. If we see a demand zone fail and it's pushed through or it's pushed into a second time with significance like closures like this, like realistically, we could tell that this zone had failed at like this point here, right? Because when we come down and we create equal lows, so at this point it was liquidity. When we create equal lows, and we've pushed with a candle body closure into the zone again, there is a very low probability that this market's going to jump from here without at least taking out the low. And if it takes out the low, it immediately tells us that the buyer intent is way weaker here than it previously was back there. So this basically writes off the zone before it's even broken through. Now we'll talk about another example of spotting supply and demand fails before they even occur in a bit, because that's another way that we can actually trade them. But as you've seen, obviously we got pretty immediate closures beneath straight after that anyway. So that really truly confirms the failure of this demand, which is just simply going to open doors to taking the market lower towards the next point that could be treated as a discount price range, right? So that is how a demand fail works. We basically work out the region that created significant buying before. If it reacts, we can take significant buying again. But if it fails to confirm and it starts to weaken back into that zone or through it, then that immediately shifts the narrative. And all we do is look for the next imbalanced range over on the left. And we use that imbalanced range and that demand that's been created further down as an easy target. It makes a very, very simple trade where we're basically just filling an open range at this point. So that is a demand fail, and that is how it works. Supply fails are going to be pretty much the same, but the other way around, okay? So taking a look at this market, we have a structural shift from higher highs and higher lows here into a lower low from here. So our movement for this market would generally be to sell supply zones because we're seeing reversal taking place here, okay? So what we would have our eyes locked on to begin with would be this area of supply just here, and then the one that's already marked on. Now, as you can see above these, there is no open supply zones. There is just efficiency, which tells us if we were to cross over this high and fail the supply, we would kind of shift that bias from looking to sell to a very high expectancy that we'd actually go and take out the swing high, because taking out these supply zones would tell us there is no seller interest at the same level there was previously, and there's nowhere really for the market to react from this point until we get to the swing high and take liquidity over there. So what we can do is see how the market approaches the first area of supply. Now here you see the market drove through the supply zone. So this creates opportunity number one. And this is going to be a refined view, a very small opportunity, but I want to show you this because it's very useful to be able to take advantage of these. So as we've punched through that supply and we have left imbalance, small imbalance, but still imbalance open into the next supply, we can actually utilize this as a low time frame example or opportunity to take the market through. So if we look at this on the 15-minute time frame, what we've actually done is fail the supply by breaking above. And if we look at this structure, it's higher highs and higher lows. So we could use the last candle before the impulse that broke through the structure. That's going to be the demand zone. And that creates a very simple opportunity to trade this market like this, which is only around a 2.5 R. You could refine it further towards, say, the 10 and 5 minute for the demand. And that would give you around 3% return on a trade like that. Now this, of course, is basically us taking advantage of this small imbalance and the fact that supply failed at this level to just lock in a small win from this demand through to the next supply. So basically by breaking above here, we were told by the market, this supply is no longer of interest. You should look at this one instead. With that push, we then take an opportunity to trade towards that next point like this, and that is where the opportunity arises. So you've got one opportunity there for a refined trade. That would be around 3.5% secured in a very simple manner, okay? Now, that's not the only opportunity, because if we jump back up to those higher time frames, you're going to see in a moment, we actually break through the top supply as well. So what you'd look for inside of here is for the market to reverse, okay? You'd be looking for shifts in the structure of the market to the downside. But what we got instead was actually the formation of some equal highs, okay? So as we said, we can actually draw from the market an understanding that the market will go higher before it fully breaks out of a range or of a supply. Because if we create equal highs like this and this, then as we know, that creates liquidity, which will act as a draw or a magnet for price. So there is also opportunity to take a buy through this high, understanding that the top of the supply here has actually created equal highs. Therefore, the liquidity above that level is unlikely to actually be left untested, right? We are likely at this point to drive through the highs. So you could look for demand. We'll clear the first example and let's go to the hourly. You could use this demand, the last candle before the impulse here, essentially where we entered off of the previous position. And then this in itself becomes a trading opportunity, right? You can buy from there, you can target there. And because we formulated those equal highs, we basically got a go ahead from the market that this zone is more likely to break upward than downwards, therefore giving us the chance to get into a trade to follow through that supply fail. Okay, so that was a case of kind of identifying the break before it occurs, and we're going to talk more on that in a moment, but that is how you would get the larger opportunity. When we see a supply, especially the final supply, creating equal highs, there's a very low likelihood the market will react from there, okay? So just to give you a rundown of that in diagram form, if we have a supply zone like this, and then the market returns to that level, the ideal scenario, the ideal thing we want to see is kind of a trade into somewhere around the 50% mark. Even if it extends rather high into the zone, it's generally okay. But the moment that we actually create equal highs, so the market's pretty much dead set on the same level as the top of the very supply zone, well, we actually kind of manufacture that liquidity there, right? The collection of orders sitting above the high, and it indicates to us that what is more likely to happen than a big drive down is at this point, even if we get a small sell-off, for the market to come and take out those equal highs. Now, the market could then trade lower, but that depends on whether it's going to be hitting another core supply. And in this case, of course, trading into an efficient range, the most probable outcome from here is simply a continuation through towards the next point of interest, which in this case is the liquidity at the top, right? The wick fill. And from there, maybe you see reversals, which allows you to get into new trades. But by creating those equal highs, we kind of forecast the next movement is going to be a broken supply and a run towards a new high. So there was two opportunities there. The more conservative was the small 15-minute opportunity we looked at running this movement, because you had the fully confirmed and fully already broken supply. And then the second opportunity where you kind of forecast that break with the formation of equal highs. It's a probabilities game, okay? Sometimes we could create equal highs and then we could sell off. But most of the time, as soon as equal highs or equal lows are formed in a market, we basically create a magnet above those levels, which makes it very unlikely that the market's going to continue down without first kind of purging that high. And if we know that's likely to happen, then we can take, when it arises, the buy side opportunity against that to run through the high. And especially when it's paired with an efficient range like this and a clear upside target, then you've got yourself a pretty clean opportunity. So as I said earlier, you can actually forecast breaks before they occur, which number one can just be good for positioning yourself on correlated assets. And number two can actually be useful to take more aggressive trades towards the direction that you think the market's going to break into, okay? So we're looking at this on the DXY. We have an uptrend at this point in time. This is basically being protected by a demand zone, which is this last candle before the impulse, right? So this demand is basically the point where at this point we saw significant buying intent. So therefore we see it as a discount. And if the market returns to it again, we should see significant buyer intent coming back into the market. Now, initially, it looked like that's what was happening. We had this first push in. The market was then able to go and push over some structural highs. So this was a good looking sign. But then we had this huge reversal in momentum, this big drive back down, which tells us that, oh, okay, maybe this is not what we think it is, and buyers are now considerably weaker than sellers. This bearish candle engulfed the entire previous range, telling us sellers have kicked in at this level after this high with significant momentum. But more importantly than that, in the terms of a demand fail, we've had a second tap to the zone. Every time a zone is retested, it gets weaker. A great analogy for this is imagine a wall, right? If you throw a big steel ball off the wall for the first time, it's probably going to bounce off. But if you keep throwing it at the wall is going to get weaker and weaker and weaker. And eventually, it's just going to break. The wall will break and it will cave in, right? That's what we're doing here with the demand. Imagine this is our wall or just a concrete floor. You've just thrown a big steel ball at it. It bounces off the first time. But every time you throw it again, it gets weaker. And if you keep doing that, it's going to break, okay? That's basically what we have here. So forget the analogy. I explained it pretty well. We're not going to draw a diagram. So with this second tap, this is the second throw of the steel ball, essentially. And what this has done is, number one, push us into the demand for a second time, telling us buyer intent is not that strong. Number two, it's pushed us through the low that we had on the first push. So we see the market is weaker here than it was here. Okay, so we're actually getting weaker at this point. Now, again, we see an attempt to go higher, but we fail to make a new high this time. So this, again, signals weakness. And when we come down and create a closure at this level, this is the real sign that this zone is basically done for. Not only have we closed into the zone for a third time, but we've closed lower into the zone than we did on the previous example. And it's a candle body closure now. It's not wicks anymore. This is confirmed weakness. This is not rejected weakness. We're not seeing buying pressure in this zone anymore. We're just seeing total seller domination. So, although the zone hasn't failed yet, it's as good as gone at this point. There is no point holding on to hoping this market's going to react. We've seen continual weakness. We're seeing the highs fail to be broken at this point. We're seeing more weakness at these highs. And now we've seen confirmed closures deep into the zone. So if we believe this zone is going to break, which at this point it's pretty much confirmed it's going to do that, what we can do is look for opportunity to sell down lower towards where the next potential discount or demand zones could be. Now here, efficient range, no imbalances. So we can basically push past this low at least. In this case, unlike one of the examples we looked at earlier, we do have a clear target that we can run into. So that makes life a bit easier. There's a demand zone just here. This can become a target for a trade on the downside. So there's now two ways you can approach this. Number one, you can find the extreme supply or the notable supply to sell from. In this case, we have efficiency all the way through to here. So there's no reason for us to look at selling directly. If we were lucky enough to get the pullback to this supply, we'd be happy to sell it here now because we know the market is seeing continued weakness. We know this demand is likely to break. So you could actually place a trade like this ahead of the break, given that we now have the 3 pushes and the deep confirmation that this zone is not going to hold. Now, if we see how that looks, you would get a tap in here and then the market runs down from that level and creates the final break. Now, this is where opportunity number 2 comes in, which is the more conservative trading opportunity. Okay, that's pretty much going to be looking for the opportunity to sell. Now, there is a very, very tiny imbalance into this supply. So you could look at this one and that would be a good point that you could place orders on. I would honestly prefer like a confirmation style entry from there, to be honest, but you could run with this. This would be okay. Even realistically, if you were feeling aggressive, you could put stops here. But the risk I've got with that is, of course, that there is the supply above that could be hit too. So that would be kind of the secondary opportunity once the break had confirmed. But the first one that I've just showed you is how you can trade out of essentially forecasted failures. When a market is weakening into a zone, when that steel ball is hitting the wall endlessly, when we start to confirm closures low into the zone, then you basically know this zone is not going to hold, okay? Because we're just not seeing that buyer intent that we saw previously. And if the buyers aren't interested in getting in here and the sellers are pushing back at every attempt, gives us the information that sellers are likely going to take this down towards another core point of demand, okay? So if we see how this plays out, there's that tap in there and then a run down to the target. Again, this time creating another demand fail, which means what we could look for is a sell from a pullback to take us down through the very low. So that's something we could consider there as well. But for now, you see how we caught a trade by forecasting a break before it occurred, and then also how you would handle the more conservative trade following out of that as well. Okay, so there you go. That is basically how you forecast supply and demand fails before they occur by using the considerations of momentum and weakness and buyer intent and seller intent in specific zones. So that is everything you need to know for today's class. Supply and demand failures are just as valuable as supply and demand retests. The great thing about these is if you take a buy trade or you're planning a buy trade, you don't have to be upset when the failure comes in, because even if you lose a trade on the buy side, it immediately opens doors to a new opportunity to basically run the market the other way. That's one of the most valuable points about supply and demand fails. Every opportunity that goes wrong turns into an opportunity that is highly likely to go well because you've confirmed a change in the narrative, and all you have to do is find the core point to sell from to profit the other way. So that's how we utilize supply and demand fails in the markets. Hopefully this has been valuable. Hit the link in the description to watch the trading diagnosis class, and with that, I will see you in the next episode of the Bootcamp.